Hello and welcome to the Canaccord Wealth Coffee Break podcast. I'm Jane Parry and I am the Chief Marketing Officer here at Canaccord Wealth. I'm joined today by Tom Hibbert from our Chief Investment Office. We're sitting here with a couple of Black Americanos, all caffeined up, ready to go. So the idea behind this podcast is to have a look at our weekly markets review, which is a newsletter we send out on a Monday every week to subscribers, and to deep dive into some of the more interesting areas in that weekly markets review, just to get a bit of a deeper understanding of what's going on. So grab yourself a coffee and let's get into this for about the next 10 minutes. So this week, Tom, we are talking about global equities, but primarily what's happening in the US, as that is the biggest market that dominates global equities. And I understand it's defying its usual September's seasonal weakness, and we've seen an unusually strong uptick in valuations of 3.4% in September so far. That's in sterling terms, across US large, mid and small caps, all hitting record highs. So can you just give us a bit of background to that? What's going on in the markets and what's made this happen?
Yeah, sure. Hi, everyone. So September does seem to have a bit of an effect on investors. It's historically been the weakest month for markets. It's a bit of a statistical anomaly, really. I would say a back to school impact, perhaps.
I know how it feels.
Yeah, this year though, it's been totally the opposite. We've seen a very strong rally, almost a melt up.
A melt
in
up.
Equities.
A melt up in equities. Okay, like
particularly in the US.
Okay.
And what's driving that is this fabulous earnings backdrop. The corporate landscape is particularly strong.
Okay, so what elements of the landscape are particularly strong then?
I mean, just profitability, company earnings, and the earnings growth looks very compelling as well. So earnings growth, forward earnings expectations reached a new high last week at the same time as those indices did. And it's also been a broad rally. So performance in the US equity market has, for the last few years, really this decade, been extremely narrow. And we're now starting to see a broadening out across the market, from large to small companies.
So that's got to be a positive, yeah?
100%.
Yeah.
And you also have, at the same time, a very productive policy backdrop. So tax cuts in Trump's big, beautiful bill, deregulation, alongside just the fact that the US seems to have abandoned the sort of fiscal conservatism or austerity narrative that they had at the start of the administration, and they're just spending tons of money. So there's a lot of fiscal stimulus at the same time. Okay.
So let's just pick up on a couple of things there. You talked about forward earnings, and you also talked about the mega caps, or sometimes we talk about the Magnificent Seven, don't we? How does that sort of translate across the whole market to that growth that we've been seeing?
So just on the dominance of the magnificent mega caps, or the Magnificent Seven, actually we'll look at the top 10 stocks in the US. Okay. They have been responsible for over half of the equity market's performance this decade. And they now make up about 40% of the market.
Oh gosh, that's massive, isn't
it? So it's a huge concentration of the US equity index, now dominated by big tech, effectively.
Yeah.
What's promising today is that the earnings landscape seems to be broadening out beyond the top end of the market. So by the middle of next year, analysts see earnings growth of 30% for the mid caps and 20% for large caps. So those are big numbers, good growth across the market, but particularly strong growth for mid and smaller companies, which is promising.
I think people are sort of drawing a bit of a comparison of the valuation of those companies with the late 1990s and the tech bubble. Is that a valid comparison, do you think? And are US equities overly expensive today?
Yes, it's true that the market is expensive. It's undeniable, in fact. So the whole market is trading on a price to earnings ratio. That ratio is at 23 times, which is just shy of the peak of the tech bubble of 25 times. Okay. Now that's skewed by the top end of the market, the Magnificent Seven, those tech-related behemoths, which continue to be magnificent. So they are up 60% from the lows in April. And that compares to 35% for the wider market. Excluding those 7 stocks.
Just explain that to me in a little bit more detail. So you say they're up by 60% since April.
The share prices of the Magnificent
Share prices,
Seven,
okay, that's what I want to understand, yeah.
Versus 35% for
the wider market. So they've risen really quite a lot.
Very strongly.
Even this year, okay.
On a valuation perspective, if you exclude the top end, those Magnificent 7 stocks, the rest of the US equity market is trading on about 21 times earnings.
So
a
still
little
high.
bit cheaper. Still high, still expensive.
Okay.
What's different, though, today from back then is the earnings backdrop. It's very, very solid, fabulous from a corporate landscape. It's just very, very strong. And also the policy environment as well, which I mentioned. So last week, if we just look at monetary policy as well, last week markets were also supported by the resumption of rate cuts from the Federal Reserve. So the Fed cut rates for the first time this year. And we should probably talk about that on this in this conversation as well.
Okay. Let's talk about the Fed then and the recent Fed rate cut. First time this year that they've cut rates. It seems we've been talking about too slow Powell for weeks now.
We have.
So what's happened in the last week or so, and how is that impacting markets?
So the Fed cut rates as was expected.
Yeah.
And they justified that through the slowdown and the softening of the labour market that we've seen, and also the fact that inflation momentum isn't there at the moment. So remember, monetary policy as well, it has a lagged effect. So it's not, it doesn't, the feed through into the economy isn't instantaneous, it's delayed. So partly the central bank is cutting interest rates now on the expectation that high interest rates have already had their impact on the economy.
Okay.
So they have to be more forward looking.
Yeah.
So cutting now is right on balance, I think. And there are people who are deeply concerned about the labour market and the revisions that we've seen from the Bureau of Labour Statistics, which has changed the narrative on the labour market. But in particular, in more recent times, the fall in job growth and the slowdown in job creation in the US. But in my view, I think that's a bit of a red herring, really, because immigration, and in particular illegal immigration, has dramatically fallen. So I think that the fact that we have lower job growth in the US, while unemployment has actually stayed very low, that reflects the fact that labour supply has in fact fallen.
Okay.
So fewer new jobs are required to keep unemployment low. And if that's the case, then weaker job growth may not be a sign of weakness at all at the moment. And it's more of a sign of the Fed having actually achieved what it set out to by hiking interest rates in the first place, which is to take the heat out of the economy, take the heat out of the labour market, to see wage growth coming down, and without the economy crashing, without having a big spike higher in unemployment. So I think that's what we're seeing at the moment is more healthy, more of a healthy slowdown that has facilitated this rate cut.
So very briefly, because I think we're nearly out of time, we've talked about US global equities. What about the impact on US bond markets?
So it's rare to see bond yields rise following an interest rate cut, and that's what we saw last week. And it's a familiar pattern for this year, actually. The bond market has voiced skepticism over whether inflation has been fully tamed. So we saw that last week with the yield curve doing what's called bear steepening.
Bear steepening.
Where long-dated yields rise more than short-dated yields. So the yield curve is steeper. And remember, bond prices are inverse to bond yields. So when bond yields rise, bond prices are falling. So the long-dated bonds in the US fell last week. The US 30-year yield climbed quite sharply to 4.7%. And as I say, that steepening is a familiar pattern. It reflects the caution that markets have of a potential policy misstep from the central bank here, and that the market isn't convinced that inflation has been fully tamed. It also reflects the ongoing fiscal profligacy of the administration, so the fact that the government is spending lots. Their main strategy is to drive growth, to continue to spend, and to outgrow their deficit, to outgrow their $37 trillion worth of debt. Where the long end of the bond market is where bond yields are rising, that also reflects some concerns around the fiscal situation and potentially unsustainability of the scale of US government spending.
Okay, thank you very much. Thank you for your time today. As ever, I've learned a lot. Global equities have bucked the usual September back to school trend, which means they've gone up. And that's quite a broad picture across small, mid and large caps, not just the usual Magnificent Seven. Arguably, US policy seems to be having an impact and achieving what the government is setting out to do, particularly around employment and inflation, which has allowed the Fed to cut rates, albeit there's a lot of scepticism around that and whether this will continue. So a bit of a watching brief. So lots to take away from the chat today. So thank you very much.
Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.